Good morning and welcome to this, our fifth Tide webinar in the series titled Building Better Credit and Strengthening Your Financial Future. My name is Jeff Frank, Senior Community Development Officer at the Island Institute. This webinar series is brought to you by the Island Institute and in collaboration with the Small Business Development Centers. Today, we're going to dive into credit scores and how to improve yours. We'll go to the next slide here.
Yep.
This is the Tide webinar series that's taken place this spring. If you'd like to take a look at any of these recordings, just go to the Island Institute's Future of Fishing Toolkit website. You can just Google Island Institute Future of Fishing, and they'll pop up. They are all recorded on YouTube, and they're also associated resources, materials, and template documents you can download that are related to these webinars. This series of webinars came together through a collaboration with advisory board members who are scattered throughout the lobster industry in Maine, advising on what the topic should be. And over the summer, we'll be taking in more feedback from you, from others throughout the fishing industry, and designing a series of webinars for the fall as well. So moving forward today. At the Island Institute, our mission is we boldly navigate climate and economic change with island and coastal communities to expand opportunities and deliver solutions. This webinar series is a part of a federal earmark that is focused on helping folks in the lobster industry, fishing families, identify ways that they can make themselves more profitable through improving their current fishing practices. Those are some of the topics that we're focused on in this webinar series, and also diversifying if folks want to try for additional forms of revenue. Lots of fishing families have multiple forms of revenue, and we have other types of trainings in this future fishing program with the Maine Center for Entrepreneurship, and also a series of grants and other programs. You can find all about those other resources at the Future of Fishing Toolkit website on the Island Institute's page. Great, next slide. One of the features of this project this spring that we've launched is with Profit Decoder, which is an online financial management tool. If you can just flip ahead to the next slide.
Sure.
There we go. The Profit Decoder is an online financial management tool that is designed to make it as easy as possible to start understanding what are the next steps you can take to find profitability in your business. And we've created one version of this tool that's just for lobster fishing. So you can enter in how many traps you fish, what the price is, how much it costs you for gas, and how much do you spend on all your inputs, what you get out of it. And you can run different scenarios to see, what if I hire another sternman? What if I buy more traps? What if the price goes down? How will that impact my profitability? It essentially allows you to look a little bit into the future for your business. We all know that small businesses can be a few decisions away from success or failure, and this helps you run those scenarios in advance. So please take a look at the Island Institute's website under Future Fishing. You can get a free 1-year account for this tool. And let us know what you think. There are also 3 webinars on that page with Profit Decoder, looking at different ways to get the most out of this tool. So we've got a lot of great feedback. People are finding it really helpful. So please take a look. Next slide. And I mentioned briefly, the business resilience grants are now open through June 1st. These are small grants that are meant to support the future fishing work. The Island Institute put these out just about every year. This round is focused on helping folks who are in the fishing industry either make their current fishing more efficient or find new ways to create revenue. So if you're thinking about starting another business, if you're looking for equipment to make your current fishing a little more efficient, let us know. Find the application on the Island Institute website or through the QR code there on your left. You can just Google Island Institute Business Resilience Grants, or email or call me, Jeff Frank. You'll find the contact information by Googling me and Island Institute. Happy to help. And with the next slide, I'll pass to our host for today, Jenn Dobransky from the Maine Centers for Maine Small Business Development Centers. Hi, Jenn.
Great. Thank you, Jeff. And again, welcome to you all to our webinar today about building better credit. Pleased to introduce Jill Loram, who is our facilitator today, certainly an expert in personal finance, and she'll say a little bit more about herself. But just wanted to thank you for being here today, and also just kind of reiterate what Jeff has mentioned already. We'll share this resource with you. It'll be up on the Future of Fishing website for you to review. And we do encourage you to ask questions, so please feel free to throw your questions in the chat, or if something comes up after the fact, certainly reach out to any one of us. We'd be happy to answer questions, any questions that you may have, and our emails are listed there. So just going to turn it over to Jill. Thank you.
Well, hello, everybody that's listening in today. I am very happy to be here. I work for, as Jen mentioned, I work for Coastal Enterprises, which is a nonprofit community development organization, a financial institution that has been around since 1977. And fun fact is that our very first investment in 1977 was in the Booth Bay Region Fish and Cold Storage Facility, which had recently been destroyed by a fire. So as the community got together, CEI and CI got formed. We invested in helping to rebuild and modernize that facility. So we have a long standing history with fishermen in Maine, waterfronts. Some of you may know our fisheries and agriculture team, Hugh Copperthwaite, Nick Branchiner. So I'm very happy to be here talking with you today about credit. I'm in the financial development services area at CEI. We provide one-on-one and group homeownership education. We provide foreclosure prevention services and student loan counseling, as well as financial coaching, which is what I do. So I talk a lot about credit every single day. So my passion is to help people improve their credit scores. I think we can go to the next slide. And I think what I'll do while I'm giving the bulk of my presentation is to turn my camera off, so that's not distracting you at all. Great. So today we have goals to learn all about credit scores and credit reports. We are going to hopefully identify some common credit mistakes and myths and some strategies to improve your credit. We don't have a lot of time today, so we're not going to get into a really deep dive, but I'm hoping that you'll get an idea of how to use credit responsibly and how to make sure you're making it work for you and your business and not against you. So if there's time, we will actually, if there's anybody actually present at the end of this, we will look for answering some questions. Jen, you can go to the next slide. All right, so why does credit matter? Credit impacts all of our lives. It determines where we live, where we work, what we can buy, and how much we pay for goods and services. If you are looking to buy a house in the future, if you're looking to buy a car in the future, and more importantly, if you're looking to grow, start or grow your business, you're going to need at some point in your life a big loan. So having that good credit, being able to confidently walk into a lender's office is really important. You can think of it
as your financial resume. It helps you buy something now. It helps you pay for it later. It helps you, it helps lenders trust you to pay back money you borrow from them. It's all about your reputation, right? Whether that's a good reputation or a bad reputation. Next slide. I think we can go to the next slide too, Jen. All right, so we're going to start right in on credit scores. There are many credit scores out there. It makes things very confusing to people. We see credit scores from our lenders. You know, if you have a credit card or two, you're going to see periodically credit scores from those creditors. There are websites that we can go to. We can think of all of those scores as educational scores. They're good to be able to see and to help monitor the range of our score, the trajectory of our score. Is it going up? Is it going down? But the most important score is a FICO score. And that's because when you go to a bank or a credit union here in Maine, and for the most part, major lenders as well currently, they are using a FICO software program. So FICO scores are the most important ones to understand right now. And you can see that the FICO score range is between 300 and 850. When you're applying for credit, it's a good idea to have a credit score at a minimum of 670 to be approved. But if you want the very best interest rates, the lowest cost of borrowing, you want that credit score to be closer to north of 740. So these scores are helping lenders predict how likely you will repay your loan, right? They are also determining what your terms of that loan are, the interest rate that you'll be offered. And there are actually many versions of FICO scores, and there are industry-specific FICO scores. So if you're applying for a credit card, they'll pull a credit card FICO score. If you're applying for a car loan, they'll apply a auto loan FICO score. There are about 10 versions of their basic score. But for the most part, when you're looking at a FICO, when you're trying to find a FICO score, and I'll give you a resource to do that, you want to check in with your either FICO version 4, which is a basic score, or your version 8. All right. So how is it? What is FICO doing? So FICO, as I said, is a software program. It's a mathematical algorithm that goes through your credit report. It's asking a series of questions in 5 different areas of risk, and there could be 10 or 13 questions in each of those 5 areas of credit risk. But basically, you can think of them as, you know, asking these questions. You know, do you pay your bills on time? How much money do you owe? How much experience do you have with borrowing money? How many times have you tried to borrow money recently? Do you have experience using different types of credit? So those are basically what FICO and most credit scoring models are looking at. Payment history, though, and credit utilization carry the most weight, as you can see, in calculating your credit score. So I want to focus some attention here for the moment. Because when I work with clients, this is where they're getting tripped up the most, either with some missed payments or collections, or they're overusing, they're over indebted. So payment history. FICO is looking at questions such as, you know, has this person ever missed a payment? If so, how recent have they missed payments? How many payments have they missed? How severe? And severe for FICO is any missed payment that is over 90 days old. So 3 months old or more is a severe delinquency to FICO. It's important to know that negative information like missed payments or an account going to collection or account being charged off or bankruptcy, those things stay on our credit report for a period of time. And that period of time is, well, with the exception of bankruptcies, is primarily 7 years. So a one missed payment could impact your score for 7 years. The hit or the weight of that negative impact does lessen after 3 or 4 years, but still that one missed payment that you had will show up in your credit report to a lender viewing it for 7 years. So think about that when you're thinking about how you are, whether or not to purchase that item. Think about whether or not you are sure you can make that payment before you make that purchase, right? Because if you fall into trouble or you get over indebted, then that's going to impact you for 7 years. So if you do miss a payment, though, it's important to remember that you can get back on track, and the rebound to your credit score can be a little bit swifter. But missing, just being careless about making payments or letting an account go to collection can cost you for a while. Important to note too that there are some laws about how creditors can report our credit actions to our accounts to the credit bureaus, and that they can't report you late if you are more than until you are more than 31 days late, or until you are 31 days late, I should say. So even though you are considered late the day after your payment was due by the lender, and you may get a late payment fee, they can't report you as late until you're 31 days late. So you can keep that in mind as well. So try to always pay on time. As I said, make sure you can make the payment before you make the purchase, and get back on track quickly if you do miss a payment. So to lessen that hit to your credit score. Amounts owed, that makes up 30% of your credit limit. So you can see the two of those factors alone make up over half of what your credit score is. So amounts owed, it really is your overall debt, but when FICO's looking at it, it's really focusing its attention on your credit cards and how responsibly you use your credit cards. So it is looking to see what percentage of your available credit limits you are using, and it would prefer to see, or it thinks that responsible credit use is when you are using less than 30% of your credit limits. So FICO wants us to have credit cards. If you don't have any credit right now and you're looking for a great way to build credit, a credit card is the best way to start out. FICO likes us to have credit cards. We will have a negative impact if we don't have credit cards. I like to have people think about credit cards, though, as a tool simply to have and to build a good credit score. And the way to do that is to use much less than that 30% that I mentioned of that credit limit. It's to use between 1 and say 10% of that credit limit, right? So if you're just starting out, you need to start building a credit score, you'd get a credit card. You might use it to pay a monthly subscription fee, something really small, $8, $10, $12. Use the card to pay that. And when you get your bill, from the credit card company, you pay that in full, and within 6 months, you will start to see a credit score. And if you're doing it that way, paying it on time, you'll start to see a really good credit score. Same thing works for if you're trying to rebuild credit. Well, just to briefly go over the other three, they do have impact to your score, just not as much as those two factors. Length of credit history is another factor that I do see show up as a pretty good negative impact to scores, and that is because people don't realize that every time you open up a new account, it's a negative hit to your score. It causes an inquiry, which is part of this new credit, 10%. It also, FICO is looking at when was the newest account open? When was the oldest account open? And what's the average length of someone's credit history, along with other questions about your experience or length of credit history. But those are the three main questions it's looking at. So if it sees an account that was open 2 months ago, you're going to have a negative drop to your score. So think about that when you are opening new accounts, and try to do it strategically. If you only need 3 max credit cards to have a good credit score, one will do it. But if you need more credit cards for whatever reasons, try to open them up over over a period of time. So open one month and then wait 6 months to open another one, just to lessen the impact. Credit mixes just simply means that, what kind of experience do you have with credit? Have you had installment type credit, like personal loans, car loans, student loans, mortgage loans, as well as revolving credit? As I mentioned, all you need is one credit card to have a fairly good credit score. You don't need to go out and get a loan just to improve that score. That will come over time as you get more experience with credit. You're naturally probably going to have a mortgage at some point, or a personal loan or a car loan. So don't run out and get an installment loan to help improve your credit. All right, next slide. So the most important thing to realize is that credit reports and credit scores are two different things. Many people think they're the same thing. When you go to apply for credit, your lender is going to pull a credit report, and it's going to choose which version of FICO to run through that credit report. So your credit score is that number that reflects the history that's in that credit report, right? So you could think of it as an exam you took, and the score is the grade. It is important to take a look at, the full credit report. There are personal identifying section. There's the section that has all the information about your open credit accounts. And we're not talking about rent payments for the most part. We're not talking about your utilities. They're not reported to a credit reporting agency unless you don't pay them and the account goes to collection. Then the collector will report you to the credit reporting agency, and that will impact you for 7 years. And then the third section is inquiries. So every time you've applied for credit, the only inquiries that show up are when you actually are applying for credit. You're signing an application. In that application, it should be telling you that they are going to pull your credit report. It should be clear for you to see. So as far as the personal identifying information, it's important to just look it over. You'll see your name, maybe several different names if you've been married or changed your name. There's going to be several addresses, maybe 1 or 2 employers or maybe none. And the information from that goes into the personal identifying information. It's not information the credit bureau looks for, goes out there and collects. It's information you've actually given to a lender, basically. So when you're applying, you fill out an application, you fill in that information. That information gets input by somebody like me, who, when I pull credit reports for my clients, I have to put in that personal identifying information. And that's, whatever's current gets put into that credit file. So you might see different addresses and things over time. If there's ever some information on there that is not familiar to you at all, an address you've never lived at, an employer you've never worked at, then I suggest first just looking through the credit report. If there is no accounts there that you're not familiar with, chances are there's nothing to be too concerned about. And you can do things like put a freeze on it so that nobody else, and we'll talk about that in a couple of slides, but you can put a freeze on the account so that nobody can open credit without your knowledge, because you would have to unfreeze that account first. So it is important to check for errors and fraud. Next slide, Jen. So how do you do that? So one of the best reports that you can get, I think, is that report that you can get from annualcreditreport.com. So many, many years ago, we needed to actually pay for a copy of our credit report. And the federal government stepped in and said, we need to make this affordable and available to anybody. And so they required the 3 credit reporting companies, Equifax, Experian, and TransUnion, to get together and develop this website where everybody can get a copy of their credit report for free. Important to know that when you go on here, you might be you might get requests to sign up for credit monitoring or paying for a score. You don't need to do that necessarily. And this report that you get will not include a score. The score that you do get, again, it's not necessarily going to be a score that your lender uses. It's going to be an educational score. So you might just want to skip paying for that. But the report itself, so the credit reporting companies have a lot of information about us that doesn't necessarily go on a lender's credit report. This report is very rich in information that is useful to you. I mentioned that negative information stays on our credit report for 7 years. Basically, when we have closed accounts, and closed accounts that are in good standing, meaning we never had any late payments on it, never went to collection, or got charged off, will stay on our report for 10 years. So good accounts stay on for 10 years. But accounts where we've had some negative impact, such as late payments or in a collection account or a bank charge off, those accounts get removed from our closed accounts, get removed, and a collection is a closed account, will get removed after 7 years, meaning after 7 years, it just falls off our credit report. That's great, because if you let an account go to collection, for whatever reason, it goes to collection, and at some point your finances improve and you want to take care of that debt and pay it off, that's great. That will help your credit history. Your credit report will show that you had an account that went to collection, but eventually when things got better, you took responsibility and you paid that debt in full, and your lender will appreciate seeing that. However, it's not going to improve your score at all. Right? So if you pay a collection, if you bring a charged off account up to date, you are not going to get credit, any credit at all from your credit score. So that is not going to improve that credit score at all. It improves your credit history. Can't stress that enough, but it doesn't help your credit score because the history on that account is that the account didn't get paid, the account went to collection, there were late payments, whatever. That's the payment history, the number one important credit risk factor, FICO. That payment history, the account was not paid as agreed. So this ability to have that fall off your credit report in 7 years is great for us, right? Because if it's off your credit score, then it can improve your credit. And if it's off your credit report, I should say, then yes, it can improve your credit score because the FICO software program doesn't see it anymore. So it could put 100 points or more back into your score, depending on everything else going on in your credit file. So that's a good thing. And the good part, to make a long story short, sorry, about annualcreditreport.com is that's the only place we can go to see when that's going to be scheduled to fall off. So regular credit reports, including the ones I pull, do not give us that date. We can guess when it is going to fall off, but we don't know for sure. With the annualcreditreport.com report that you get, it will give you on these negative accounts with negative activity in them, it will give you the scheduled fall off date, which is wonderful. So that can help us understand when this will start improving our credit score. It also, if you have an account that went to collection and you're struggling to find out how to contact that collector, it will give you that contact information as well. So annualcreditreport.com, initially it was 1 year, one per year from each of the three. Now we can do one per week from each of the three, which is great. You don't need to look at it that much, but checking it every 3 months would highly recommend. At minimum, check it every year. But there are other sites that you can go to as well. You can go to each of the three credit reporting companies themselves. There's Experian will give you for free a report from Experian with a FICO version 8 score. So that's a pretty good deal as well. And that's a monthly offer. TransUnion, you can go there and get a copy of the TransUnion credit report, but you need to sign up for their monitoring service, unfortunately. And Equifax, again, they're going to be promoting their monitoring services first, but if you dig deeply, you'll see that they do offer a core credit product, which is free. And that does come with a score, but it's a Vantage score. So that's not one that your lender is currently using. And I have to say that, because we have this access to annualcreditreport.com, because at least from two of the credit bureaus themselves, we can get a free copy of our credit report. I don't necessarily think that credit monitoring, paying for that, is something you necessarily need to do. If you're really nervous about fraud or something like that, it might be better to just put a freeze on your account. And that is a very easy process. You just go to each of the three credit reporting companies. They'll have a link to put a freeze on it, and it happens immediately. The only thing you need to remember is when you want to apply for credit, at least an hour or 2 hours before you're going to fill out that application or turn in an application, you want to unfreeze that account so that that credit report, so that your lender can pull your credit report. After they're done, you can just go back in and freeze it. And that just, nobody can open up credit in your name. Normally, all lenders are going to pull a credit report in order to extend credit to you or determine whether they will extend credit to you. And if somebody tries to apply for credit in your name and the lender tries to pull a credit report, there'll be a freeze. They won't be allowed in there. No lender will be allowed in there. And you'll be notified, and then you can take it from there. There are other sites too. You might have heard of websites where you can go to Credit Karma, NerdWallet, two good sites. They're not FICO scores, but you can get scores, and you can also get free copies of your credit report, at least with Credit Karma, from 2 of the 3 credit bureaus. All right, Jen, next slide. So as I said, late or missed payments, and know you can make the payment before you make the purchase. That's a good statement to have on your refrigerator. Missed payments, as I mentioned, it's going to impact you for 7 years. You don't want that hanging over you for 7 years. If you do miss a payment, though, try to get right back on track as quickly as possible, and the negative hit from that score can rebound a lot faster. If you think that, things are really going to get worse for you financially, then it's always a good idea to get in touch with the lender, right? And make some type of agreement and let them know what's happening. The second most important thing to the FICO score is those credit cards. It's probably the number one issue I see from most of my clients is high credit utilization rates. Again, I like to have people think about credit cards as a tool to have a good credit score, which will help you feel so much more comfortable and confident when you're applying for a new boat loan, or buying a house, or getting a new car, another recreational vehicle, whatever. You want to be feeling as comfortable as possible about your score before you submit applications. Closing old accounts. It is typically, everybody's situation is different, but in general, I would say if you have credit card accounts, even from, some of the highest credit interest rate credit cards that you have, I would say keep them open. Do not close your credit cards. It impacts that credit utilization rate. It also is something that you can have as open active credit for the rest of your life if you're handling that account well. And that's important because without open active credit, we can't have a credit score. And if all we have are installment loans, those have a set term. And when that term is over, now you don't have any open credit. A credit card allows you to have an open active credit account. You don't need, if you have 10 credit cards now, I'm not saying you need to use all 10 of those credit cards, but keeping in mind that credit card companies will close out those accounts due to inactivity, especially charge accounts like retail store accounts, such as TJ Maxx or Home Depot, or other retail stores. They often will give you a year and then they'll close them out. So keep that in mind. If you've got credit cards, try to keep them open. There are some circumstances that, would be safe to close some of them out, but I would have to look at everybody's situation individually to say whether that's a good thing for you to do. Co-signing loans, just be very careful. Remember that that loan will be reported on your credit report. And, you know, if that person who owns the loan and is supposed to be making payments gets into trouble and can't make payments, that's going to show up on your credit report. That's going to impact you for 7 years. So just be very, very careful about co-signing loans and ignoring your credit report. You know, if there's mistakes in there that you know that you're not aware of, they're impacting your score. You don't want to get to a lender's um, office, you know, with your application for a new business loan and not know what's in that credit report before you go in there. You don't want to be caught off guard. Okay. So steps to build or rebuild credit. As I said, building credit is easy. You know, the best way to do that is with a credit card. If you've never had credit in the past, your lender may require you to take a secured credit card. That simply means that you will provide them with a security deposit. That could be $300. It could be $1,000 if that's what you agreed to. And they hold on to that deposit for maybe a year, maybe a year and a half, 2 years before they give the deposit back to you if you've been using the card responsibly. It's a regular credit card. It doesn't look any different to a credit report or a FICO score. It's just simply you need to give them that security deposit. Then they'll give you a credit limit that is in the same amount, typically, not always, as that security deposit. You can find those, a great place to find them is at your local credit union, but you can find them online as well. Just be careful. I like to, you know, recommend to my clients that they're, you know, they're going to sites like Capital One or Chase or Citi, the major, you know, credit card companies out there. Some of the credit card companies, if you're, you know, you have a Credit Karma account, they're a free credit report, but the reason they're free is because they're are credit card companies that sponsor them and allow them to offer those free credit reports to us, and they get to advertise to you, or they get to recommend to you certain credit cards. And the lower your credit score, the worse the credit score is going to be. So just remember, you know, Credit Karma is a great site to keep track of your credit score, whether it's going up or down, to see what's in your credit report, but ignore some of the recommendations they're giving you and go directly to, if you're going online, Capital One or Chase or Citi, one of the bigger credit card companies. You can also get a small loan, typically. Another great source for those is credit unions. And, you know, you may get a loan for $1,000 and pay that over 12 months. The only problem with it is with getting building credit that way is you either have to get another loan after that one goes away, or you start to lose your credit score. Your credit score gets lower and lower until you don't have a credit score. So credit cards are typically a really good option for building credit. For rebuilding credit, same thing. You know, if you've had you know, I've absolutely seen folks who have charged off credit cards and then didn't have any brand new, didn't have any existent open credit cards and gone to that same company where they charged off an account. And their credit score had improved somewhat, so they were able to get another credit card. So credit cards are great to build or rebuild your credit. Just keeping in mind, though, you need to think about it differently. You have to think about it as a tool, and you have to use that credit card the way FICO thinks is responsible, meaning you have to use the credit card and you have to use a very small amount of that credit limit. And even if your credit limit is $1,000, I wouldn't recommend using more than $10, $15 a month on that card in order to build that credit, in order to rebuild that credit, right? Setting up automatic payments is great. Just be careful a little bit about setting up an automatic payment, just making sure one thing you don't want to happen is for a creditor to attempt to take your payment out and you don't have money in there. Then you have late fees and overdraft fees and all of that. So just be very careful with setting up automatic payments. Absolutely reducing credit card balances. That's the number one thing you can do today, I think, is to take a look at what your credit limits are and what your credit card balances are. There are tools out there to help you figure out how the best way to lower your credit card balances, whether that's through the debt snowball you might have heard of, where take the smallest balance first, and spend any extra money that you might have on paying that down, and then taking all of once that's paid off, taking all the money you've been paying for that on monthly and add it to the next account that you decide to pay off. And then, continuing to do that until all your debt is paid off. Debt avalanche is just the opposite, taking the highest debt and paying it down. But there are sites like PowerPay, and that's through the uh, Utah State University Extension Program. PowerPay, that's been around. It's one of the best tools that you can use to help you strategize paying down your credit card balances. But there's also other sites called Undebt It, UNDEBT .it, Undebt It, UNDEBT.it, Undebt It. That's another tool that a lot of people like to use to help them figure out the best strategy for paying down credit card balances. Keeping old accounts open, that's, as I mentioned about the credit cards, those FICO, that average length of credit history that is one of those 5 areas of risk. It's only 15% of your credit score, but it does tend to, have an impact on credit scores more often than not. And one way to have a long, rich credit file is to have, those old credit cards. So if you open a credit card now, keep it forever. If you've had one, try your best to keep that account open. Try not to close your credit cards unless you find that having those credit cards available, even if they're in your car in the glove compartment, if they're in your mother-in-law's house, it would tempt you, then it's, maybe get in touch with me and we'll talk about strategies. But in the meantime, try to keep your credit cards open. All right, Jen. All right. So lenders, when you are applying for business credit, so you're applying for a business credit card or you're applying for a boat loan, any type of loan for your business, because you're a small business, they're going to use your personal credit to make a decision on whether to give you a business loan. So you know, another reason why your personal credit is and your credit score and your credit history is so important because it's going to help you to grow or start that business. And then, you know, if the lender decides to offer you a loan, you know, it's important to ask them, you know, where are you going to report this loan? Some lenders, if it's a installment type of loan, not a credit card, some lenders will report that loan to your personal credit. So that will show up in your personal credit file. Even though it's a business loan, it will state that it's a business loan, but it should show up in your personal credit. Some lenders will only report to some of the one or more of the business credit reporting agencies. Um, those agencies are harder to get copies of our credit reports. Um, it is doable, and the credit report will look a lot different than our personal credit reports, so they're hard to read, but that's a topic for a whole nother session, business credit. Just the most important thing I think to get out of this is that when you do apply for a business loan or a business credit card, ask the lender, ask the creditor where they're going to report that loan. So that just so that you're aware. Is it going to show up in your personal credit report? Is it not? You know, is it only going to show up a business credit report? And where is that? Where can you have the ability to view how they're reporting that loan on you? Credit cards are a little bit different. Sometimes you'll go into Bank of America and ask for a business credit card. Important to ask where they're going to report it. Some will report just to your personal file. Some will report just to a business credit reporting company. Some will only report to your business credit reporting company. And if you default, if you miss a payment, they'll start reporting it to your personal credit file too. So again, um, that will be in that fine print of that credit card agreement somewhere. So you can find it in there. So again, check sites, you know, annualcreditreport.com. You can go to each of the credit reporting companies' websites. Credit Karma, again, is a great site to see two of your credit reports. And just keep in mind that your score that you're seeing is a Vantage score, which right now is not used by too many lenders. But keeping an eye on whether that score is coming up or going up or coming down is really important, and checking for errors is really important. There are several organizations doing financial coaching here in Maine. You can certainly come to visit with me. I pull your credit report. It's a soft pull, which means I get that credit report directly from TransUnion, just like a lender would. I run a version 4 of FICO, just like a lender in Maine would. The only difference is that you are not applying for credit, you're applying for coaching services. It's an educational request, and so they will not put it in your file where it's visible to other lenders, meaning it will not create any impact at all to your credit score. So you pull your credit report, we talk about, you know, what is impacting your score, how, you know, what steps to take to help to improve that score. We can talk about, you know, budgeting and all of that that may be required in order to help that score improve. There are also lots of counselors around the state through New Ventures Maine, another great organization that provides one-on-one financial coaching, as well as great series of classes. And then for business planning assistance, of course, I typically am working with clients who are starting a business, and they are working with either CEIs, business advisors. They might come from SCORE, and also through the Maine SBDC. So there's lots of free business advising out there, and I always recommend, if my clients aren't come to me without having a business advisor, I certainly encourage them to talk with a business advisor as well. So, wow, we are right up to it, Jen. As far as time, what can you do this week? You can pull your credit report, annualcreditreport.com. Look at all three of those credit reports, please. What can you do this year? Again, you can pull that credit report every January 1st. If there are things in there that you don't like, if you're concerned about what your credit score is, I would highly recommend that you get in touch with somebody from New Ventures Maine, or you can contact me and sit down and talk about how to make some improvements as your New Year's resolution, right? And I think that's it for me.
Great.
Great.
Jill, thank you so much. That is such a rich presentation and brings up a lot of different questions. I'll jump in with a question of my own. Separating, if I'm a fisherman and it's just a personal business, maybe I have one or two family members working with me, and I've decided I haven't incorporated and created business accounts. It had always been one incentive of creating a separate business account that you can then apply for credit cards for your business. And maybe there's been some misnomers around that separates necessarily the risk completely off yourself. But I'm understanding from your presentation that you still have a guarantee as your personal guarantee for those business credit impacts, or how your business's credit score is impacted. Is that correct?
That's right. So if you're applying for any type of business loan as a small business, typically you are giving a personal guarantee, right? And it's going to show up in your personal credit, your personal credit file, as opposed to your business credit file.
Okay, because I know after the January storms, there were loan agents like SBA and FEMA who were offering loans, but wanted personal assets as collateral, and like personal homes as collateral for loans, business loans for wharf repair and things like that. And I think that deterred quite a few folks from taking those loan opportunities. But it sounds like just in terms of how a business credit relates to personal credit, it sounds in line with some of that as well. Can you talk about any other, one thing that we see quite a bit in the fishing industry is an older generation lending their credit score to the new generation. I know you touched on that quite a bit, and it's really useful for people to understand that what are the impacts of lending their credit score, co-signing on loans. Are there other ways that an older fisherman may be lending their resources to their credit score, their financial payments? I mean, there are a lot of regional banks that have done business with each generation going down the line for the same types of boat purchases. Are there any new risks, or can you just highlight some of those aspects that maybe an older and younger fisherman should be thinking about as they share credit?
Right. I think, if you're working with a trusted family member, somebody that you're going to be in contact with on a regular basis. When I say be careful about co-signing loans, if a friend asks you to co-sign a loan, that might be troublesome because, maybe they move and you lose contact, and, whatever damage they do their credit, well, not that loan in particular, if they stop making a payment on that loan that you've co-signed for, then that's going to show up on your credit report and it's going to hurt equally as
Mhm.
much as it does the original, owner of that loan. So co-signing is tricky, if it's a grandparent or a parent that's co-signing, that's typically a safer option, not as risky, I think, because, you have access to your parent. If the parent starts to struggle with a payment, there's communication, hopefully passing between them, and somebody can step in, whether it's, the person who co-signed to help make those payments. It's more just being aware that, when you co-sign a loan or credit, you're a joint owner or even an authorized user on a credit card. So authorized user, you don't own it, you don't make payments, you're not responsible for making payments. Authorized user just gives you permission to use the card. And a lot of people have used that as a way to build credit. A parent has really good experience with long history with this credit card, and they don't overuse it. They keep a small balance on it every month. They know how to responsibly use it, and it's helped somebody, one of their children out by putting them on as an authorized user. But when that authorized user may have been a partner that's no longer in the picture, that's a problem, because if they stop making payments on that credit card, it's going to, right now, with the FICO scoring model that's being used for the most part,
Mhm.
it is impacting that person's credit score almost just as much as it is the original owner of that credit card. That's
It- And I think it's worth noting right now, as we're talking about credit cards, that organizations like CEI, Island Institute to a lesser degree, have these, well, CEI has rapid loans, where if somebody's choosing to put significant amount of money on their credit cards to make it through the season, to make quick payments that they need to make for the season, those options are out there from CEI's rapid loan programs. The Island Institute has a Glen Fund loan, which oftentimes is helping folks who need funding and maybe different repayment programs based on harvest. Those options are out there, and they may not be as risky as the credit card, the rates that are on there for carrying a balance. Yep. Certainly. Well, thank you so much. Jen, did you have any other questions or to add
No, that
here?
was a great discussion, Jill. Appreciate all your expertise for sure.
Yes, and just to wrap up, this is the last webinar in this series. Over the summer, we'll be reaching out. If you have joined any of these, you'll probably gain an email to ask for feedback, new topics that we should explore for the fall season. We'll be taking feedback all summer. We'll be trying to get this information out in relatable ways to folks in the fishing industry. And once again, all of these webinars are held on the Island Institute's Future Fishing Toolkit webpage. You can find it just by Googling that. You can also get more information by following up with me, Jeff Frank, at the Island Institute, at jfrank@islandinstitute.org. And Jenn Dobransky, you are always available if folks would like some one-on-one help at the SBDC. So
Yes.
thank you both very much for joining us, and thank you everyone for watching. Have a good rest of your day. Bye.
Thank you. Bye-bye.